On the court or in the markets, performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.
Hi traders, welcome to this webinar with me, Jon, Senior Market Analyst here at Anzo Capital, and our very special guest, Lynzy, who joins me from time to time on these webinars, giving us a really nice sort of difference of opinion when it comes to his background. And I'm very much of a retail background. Lynzy's very much of a sort of hedge fund background and whatnot. So he has a lot of experience that we try and milk from Lynzy every time he's on the show. So today we're going to do the exact same thing. We're talking about how to trade major news events. There's been a lot of news going on in the markets recently, actually, where it's kind of chopped back and forth. So we'll talk a little bit about kind of what's been going on in the markets too, because yeah, there's been a hell of a lot going on, and can cause a little bit of sort of whipsawing effect in the markets. We can see, you know, the market has been very, very choppy over the past couple of weeks as well. So we'll discuss that too. But first of all, Lynzy, welcome. How are we? How are you doing?
Thanks for having me, Jon. We were discussing recent relative sporting events in our lives from the past month or so. I know we could really spend the entire webinar discussing that, so we won't bring those up again. But yeah, like you said, plenty of major macroeconomic news events that we can discuss. So I think I'll let you get straight into it.
Do you, so for our audience that may not know or haven't seen our previous webinars, can you just introduce yourself again a little bit? And I would love to know how do you keep up to date with like the day-to-day news that happens in the markets, or are you looking at it from like a bit of a overview? I've always been interested to ask you that question. I've never really gotten down to that.
Yeah, sure. Actually, before I start, am I coming across clearly and in real time as I talk? Because it's a little bit delayed on my side.
It's a little bit delayed. I did remove the video from the background, hoping that would kind of help a little bit. Let me see if I put it on a 2. Try that. Is that a little bit better? It's still a little bit. Still a little bit.
So I move myself forward and backwards. It's still a little bit delayed, isn't it?
Yeah, a little bit jumpy. I mean, we can hear you fine. We can hear you absolutely fine.
Okay. Okay. So to answer your question, yeah. So my background started very much in corporate. I came from an investment banking background and then moved over to trading. My first corporate trading role was at Susquehanna, which is a quantitative market making firm specializes in options. In terms of do I keep up with day to day, the answer is yes. So throughout all of my roles, going into being in forex brokerages and being the head of trading at a few of them, yeah, it was, I thought, pretty important to be on top of that, and I've kept that up ever since. I guess I've learned to be a bit more selective about which particular announcements are significant. So I use Forex Factory. There's many others that you can use. I know you use a different one, but it kind of doesn't really matter as long as they capture the major events. You can see that there's just so many, as you can see there. But Forex Factory is good in the sense that they actually have a color-coded system as well. So you kind of know which ones are the important ones because you can just filter by the red. But yeah, if you do want to be a serious trader, you very much have to be aware of what major announcements are coming up for 2 reasons. Either you want to trade around them, or you actually just want to actively avoid trading into them because you don't want to live with that volatility.
Yeah, for sure. And I think actually most traders trade around news events more than not, I would say, because they see this news event happening and they see the specific time that it's going to happen. And they think, well, that's a good time to trade where, essentially it can be, but also there are a lot of risks around trading news events, which we're going to cover today as well. But also, you made a really good point there. And this is a question that I have for you immediately. So if you're unfamiliar with a economic calendar, like you said, Lynzy talked about Forex Factory. This is probably the most, I would say, freely and widely available and probably the most used economic calendar in the retail trading space, at least. And what it shows us is when the event is, what impact that could have on the market, the key sort of details of that, and then it gives us an actual forecasting previous, along with previous details that we've seen before. Now, what we see from sort of these ones in particular is, or what most traders will look for is, if it comes out red, it typically means it's bad for the currency. If it comes out sort of green, it can typically mean that it's good for the currency. Now, we can go into that on a bit more of a granular level. So as well, so there are other economic calendars out there, like you said, especially kind of like pro versions, which gives you sort of a minimum and a maximum filter as well, which kind of helps you understand sort of deviations away from that. But this is a question I have for you as well, then, before we kind of dive into the sort of events and their expectations versus the reality. How do you just stick with what is red folder on the economic calendar, or do you look at all of them to dictate sort of which is which? Because like on this calendar here, it says US PPI is a red folder event, but on other calendars, it might be a yellow folder event or an orange folder event.
So it's a good indication if you are just starting out, but as you become more and more experienced, you will realize, exactly as you pointed out, that a PPI is probably not going to be as impactful as, say, a CPI, and it's certainly not going to be as impactful as a central bank announcement. But I guess they don't have different shades of red, so there's only three colors there. But yeah, I remember one of our old work colleagues from the Philippines, actually, one of our junior colleagues asked me a question about which major types of news announcements are the ones that move currency markets. And as I was giving the answer, she said, "Can I start writing these down?" Which, I don't know if you've had that before, but you know the answer. But when someone says they're going to record it or write it down, you suddenly start second guessing yourself, thinking, "Wait, am I going to say the wrong thing?" Because she's going to think I'm an idiot for the next 2 years. Yeah. So we're not going to see it that often. But
is NFP important? Maybe.
Yeah. Also, what does NFP stand for? Like, you just start second guessing.
Yeah.
But very simply, I just thought of it as like a pyramid. So if you think of it as what is the biggest impact on currencies, the answer is interest rates. So you think of interest rates on the top, and that is just central bank announcements. And again, it's the deviation from what people expect that matters. So it doesn't matter what it was before versus what it is now. Those red and green numbers have nothing to do with whether it's gone up or down. They are to do with whether it deviates from consensus or market expectations. And that's the thing that moves markets. And you know for sure that a central bank announcement will absolutely move currency markets if there is a deviation. So if people are expecting the central bank to hike and they decide to keep it the same, that means the currency is definitely going to fall. It's very rare that you get absolute zero movement. One example, though, was earlier this week where everyone expected the Bank of Canada to do nothing, and they did exactly that. And you saw there was basically zero movement. You couldn't really trade that. So yeah, you start there, and you've already hit the nail on the head with the next one. So the next bit of the pyramid is, well, what affects central bank decisions? And they are inflation and employment. So generally, central banks have this dual mandate. Some central banks, I think, have just a single mandate, which is to target inflation. But that's actually how we practically did it in Australia until like 3 years ago, when we adopted explicit dual mandate for employment as well. So inflation numbers, unemployment figures. And in this bit of the pyramid, I also include GDP. Now, this
Okay.
you could put it below, you could include it there.
Yeah, I was about to put it in underneath.
Yeah,
Like
very
that.
valid as well.
Yeah.
Yeah, and basically this next bit of the calendar, of the pyramid is anything that affects inflation and employment and general growth. So that's all the tertiary things like maybe retail sales or whatever. So
Yeah.
yeah, that's how I think of it. Is there anything significantly different in the way you approach it?
No, I feel exactly the same. And then sometimes I'll try and include surveys, but I really kind of put surveys a little bit lower than that, just because sometimes these surveys aren't as accurate as you think, and
Sure.
sometimes they go out to very similar sort of businesses and people. So sometimes the surveys can be a little bit confusing when it comes to the outcome of those. So I try and stay away from surveys a little bit and kind of mainly focus on inflation and employment more than anything. And then obviously growth as well is a big part of it, because obviously there's a story back in the, if we think of what was been going on in the UK for a large period of time, was the fact that they were really worried that growth was not really going anywhere. And obviously you can measure, is it two quarters of negative GDP is usually a technical recession. So
Yeah, that's right.
GDP is important in that sense. So really speaking, I try and really focus on inflation, employment, and like you said, growth. I take inflation a lot more seriously these days, and that's mainly because inflation's always been important, but central banks can kind of dictate which one to focus on a bit more than others. And obviously, this week has been a huge week for the US, and we had core CPI and CPI out this week, and we had a new Fed chair come in, and Fed Chair Walsh has been very much like, the part of the mandate he's really focusing on is that inflation. He wants to try and bring inflation back down to target levels. Now, we can argue on what the target levels could be or should be. I mean, usually it's around about that 2% level. But a lot of the times it can be sort of, 2 to 3%. And we've heard a lot of talk about that range now. So it's whether or not 2.8% is good, or is that just, oh well, that's top of the range, we don't need to do anything, we can still be restrictive, or what, or many other different things like that. I don't know if you agree on that.
Yeah, no, that's probably correct. That's probably what I was thinking as well, especially about the recent focus as well for recent events.
Yeah, for sure. We've had a few questions come through already. Sorry. Hello, Prosper. Hope you're doing very well. Thanks for joining us today. Esther as well. Hello to you. What do I need to start trading? You can head over to anzocapital.com and sign up for a trading account for sure. I'm a beginner. How do I start trading? Well, we've got a few webinars coming up in the future. We've got an introduction to FX webinar by our Kenya analyst, Nick. Yeah, so you can have a little look at that one as well. And we'll drop, keep an eye out for the sort of links and stuff that will drop out soon for that. Yeah, so really speaking, what we're going to talk about today is, how do I actually trade this information, and how can I be a little bit more thought processed in terms of planning for these big events as well. So the big event really is, like we said, inflation and employment. And it's been a perfect week to kind of demonstrate that. So I'm going to just bring up a chart. And hopefully I can try and do a little bit like a side-by-side thing. And we can try and get up sort of the chart as well as, let me get rid of some of this information here. But like I said before we dive into the chart, I want to talk a little bit about actual forecast and previous, because although that you can sometimes still get a negative or a positive print, but the market still doesn't necessarily move on that. And that's where I like to look at a little bit more of a detailed economic calendar, because I like to look at how far that deviation is away from the expectations. So, for instance, this week on Tuesday, we had CPI. Now, the inflation rate was largely expected to come in lower. And I did think that 3.8% was a little bit of a high number still, because the inflation rate, or the headline inflation rate, still kind of takes in the oil situation. And oil had been dropping quite considerably. I mean, it was at pre-Iran war levels. So for me, that was okay. Well, I actually expect headline CPI to come in a little bit lower than probably what the expectations were here, but it did. So the minimum side was 3.7%. So you can see actually the forecast of 3.8, but you've got a minimum of 3.7 and you've got a maximum of 4%. So what I like to look at is, well, if that's the minimum and maximum, how far are they deviated from this side? Now, this little tool that I'm using here is provided by Financial Source. And what they really do, that's a really handy little tool, is they have a little lightning bolt next to it, which shows you that there has been a strong deviation away from the minimum or the maximum. So what this does, it just highlights immediately that that data was poor for the US dollar. Or it's not necessarily poor for the US dollar in that sense. It's how it's going to impact interest rate expectations going forward. So if inflation comes in lower, then a central bank essentially may look at their, mandate and say, well, one, is it within target range? What do we need to do to potentially, if it's kind of becoming an environment where it's deflationary, they may have to support the economy by lowering interest rates. If inflation is too hot, are they going to have to hike interest rates, or do they feel that it is restrictive enough? That's the way I kind of gauge it. It's almost like hike, cut, neutral. Now, obviously, we've had a lot of talk from the central bank saying that inflation needs to come down towards target, and this is pushing it towards that target. So there's been a lot of talk about rate hikes, a lot of talk about having to control inflation, things like that. But if we are seeing an inflation rate that's going towards targets, then it brings into question, are the central bank going to actually do anything? And that's where the market's almost like a forward-looking machine, I like to call it, and it tries to price in these things. So on that announcement on CPI on Tuesday, if we take a look at this gold chart here, if I just take off that there, this was the CPI announcement, this candlestick in here, right? And the reason why we had that big spike was because gold is a non-yielding asset, right? Dollar weakened significantly off the back of it, and also US bond yields dropped. So we saw gold shoot higher, okay? Now, what a lot of retail traders do in this scenario, though, is they would buy that. They would see that very strong impulse and try and chase that move. And I've seen it time and time and time again. And I have done this myself. So I understand where a retail trader's mindset is. But in that move there, you'll often see retail traders trying to pile in on this move. They'll put their stop losses below the candlestick low. And the likelihood of that is you'll get stopped out. So what I like to do is, I don't like to chase the initial move, but I like to understand what this means for that particular market going forward. And if it means that, are we going to see maybe a continuation of that? And there's a real neat thing, or a trick that I like to use, and that's just using US bond yields to almost cement whether the idea is sort of, say, correct, but you're not going to be 100% right, but also it almost has a bit more of a macro back end, right? Because bond traders are constantly trying to price in what interest rates are going to be, and they're trying to always, and essentially the US 2-year almost front runs what interest rates are going to be. So this was the CPI candle in here. So US CPI, right? Now, typically, like I said, when yields fall, gold rises, and that's why we had that spike in gold. But what I also noticed was we were getting this kind of like continuation of that downside at the time. So when the announcement happened, over the period of 4 hours, we were kind of breaking through these lows in here, and the market was dropping. I don't know if I can go to an hourly chart. Okay, there's an hourly chart. And we were trading around this sort of area, and the market was dropping. So I was looking at this thinking, well, is there a potential trade idea forming because of that, right? So if you look at the 15th of July, so one tool I love to use as well is market profile. And I've actually recently built a little market profile tool for MetaTrader. So if you just click P on the chart here, I'm going to just add in that market profile, right? Now, what I can see here is we have a very high volume area down through here, right? And what this basically shows me is you've got the value area high, value area low. 70% of trading has been done within this zone in here. And this has been sort of the most traded area within there. So you got the point of control just through here as well. So as a trade idea, you could say to yourself, well, okay, US bond yields are continuing to fall. Is there a long idea on gold? Yes. But do I want to buy there? Or do I want to buy at a strong level of support? And that's how I like to look at these moves. So price came in, could have been a really nice idea to be long around this area. And then you could have at least had a stop loss below the volume area, or at least this kind of high volume node with targets at least 2, 3 to 1 potentially, instead of trying to have a stop loss that is 610 pips wide. You could have had a stop loss maybe around about 180, 190 pips, right?
Sure.
And then this actually happens the day after. So when we had another inflation print, which was PPI. So PPI came out. And again, we had, so let me just change it on here because it filters it as a medium. So core PPI came in and was a little bit below expectations as well. PPI year on year, 5.5%. So it wasn't as drastic as CPI, but it still had an effect on the markets, because if you go and take a look at the US bond yields, again, the 2-year, which is like the front end, we can see PPI dropped here. So again, we had a US yields that were continuing to fall, yet gold prices rallied and then started to drive in lower. So you can see my trade planner on there. I don't know if it's probably not as clear because it uses like a dark blue line, but waited for price to basically come back down into this point of control, this high value area for price. Waited for waited for price to kind of close above that point of control, then enter the long position, put my stop loss just below this area, this value area low, targeted up towards that 4076 handle. So this is how you can kind of combine those little bits of information together. And I did have a little bit of a sort of graphic to show this. And I know this is something that you wanted to talk about as well, was waiting for price to almost have the event and then look at the decision and how that impacts markets going forward.
Yeah. So yeah, actually, I can't fault anything that you said, and actually, we're again not too far off being very similar in the way we think about these. So I guess, yeah, like the very simple way I think of it, I think it's more simple than how you described it. You've got a lot more sophistication in your timing, but generally, you don't want to get that spike and then go, well, it's positive for gold because yields are down, dollars down, let's just buy here. Because what you invariably find, and this applies whether it's a major news event or whether it cracks like a support or resistance line where there's some sort of breakout. Whenever you have a breakout, there's always some sort of pullback. As you get more experience, you'll realize that this is self-evident because I haven't defined how long it takes to get to the pullback. So by definition, you will always have one. But there will be a pullback, and if it is a true move, you'll see a resumption. So I just think of those 3 words: breakout, pullback, resumption. So 1, 2, 3. And then you want to get it on the resumption, which is essentially what you were getting as well. Now, I guess the artistic bit of this, because trading is a little bit scientific, a little bit artistic. The artistic bit is how much of a resumption do you need to see? And this is actually something that is something that you develop yourself over time. That is, I can't really give you a correct answer. I can't say, well, a 10% resumption is enough to get in, or a 50% resumption is enough. Like personally, as a rule of thumb, I use 50%. Now, obviously, the higher the number, so the more of a resumption you get, the less upside you're capturing, but the more certain you can be that there is a genuine resumption. So, if you're a little bit more risk taking, you might be happy to see a 10 or 20% resumption, jump in there and hope to capture most of it. But you can see here, you could have easily gotten that wrong on the CPI data at least twice. I can see there if you try to capture a resumption. And yeah, of course, it's even if you time it perfectly, you don't always get it correct. No one gets anywhere near 100%. But I find that if you wait for that initial pullback and then catch it on the next wave, it does two things. It gives you time to breathe and assess whether or not you actually agree with this initial move. And secondly, it gives the market time, as you pointed out, John, it gives the market time to actually find what it thinks is the right level. And you can see where the level of support is, and you'll see then it push it back up. And I think this is actually clearer on the PPI data because the CPI data had a day to work with anyway before the PPI came out.
No, for sure. We do have a question. It says, if we have low CPI and inflation rate is within forecast, how will this information affect gold movement? Do you want to answer that one?
Yeah, sure. So it's within forecast, but it's within the forecast. How this information? Yeah. So I guess this is where having the median expectation is kind of helpful. And I guess this would also apply to, say, central banks who will say there's 12 members and they expect, say, 10 of them to say we're going to keep it the same, 2 of them say let's cut, but then in the end it comes out that 4 of them said let's cut. So now you can see that's a dovish move, so the currency should fall. So this is where even if it is within the range, there is still a median expectation that the market. So the market is always really just a weighted average of everyone in it. So we count towards the market as well as traders. It's just that our weights are extremely, extremely low because of the amount of money that we are actually trading with. And the big banks have a much greater weight in the same way that all the big tech firms have a much greater weight in indices. So it works the same way, but you do need to take that weighted average into account. And that's why it's good to have the minimum and the maximum, but you do also need to know where the median expectation is. And so in this case, if it's at the lower end of the range and that is below expectations, you would still see that initial drop in yields, which is positive for gold. But vice versa, if just because it's in the lower end of the range, if the median expectation happens to be lower than that, you would see the opposite.
Yeah, nice. I was going to ask you a quick question on that because you have the institutional side background. With how reactive would they be to this type of event?
So actually, this is it's a very good question because it plays into something else. You actually indirectly touched on this. So the way we've both been talking, we're talking about trading news events after they come out, and I assume that this is the way you envisage this whole conversation going. But a lot of people think of trading news events as, well, I have an opinion that it's going to be this. And so 1 minute before, I'm going to take this position, and then I'm going to cross my fingers and hope that it goes in my favor. Now, to me, to call that trading a news event is like saying playing roulette is investing, or saying that you meet a lot of these people who say, I'm a crypto trader, but actually when you start to talk to them, you realize that all they've done is picked a very obscure cryptocurrency, put some money in long, and then just sat there crossing their fingers hoping that it goes up. So I'm not saying don't do that. Like it's your money. If that's what you want to do, that's fine, but that's not trading. And I also don't think that taking a position leading into a news announcement and just hoping it goes in your favor is trading. That's more of punting. Now, unless you have a very good reason to deviate from the market, which most retail traders don't, because we are not as informed as the big players in the market, then yes, when we talk about trading news announcements, we are talking about trading the aftermath of it. Would that be accurate to say?
Yeah. No, I fully agree, because there was actually and I think I've mentioned this before on the channel and in one of our webinars, but I used to trade news events by putting one order either side of the hourly candle.
Oh, yeah, I remember that.
So what I would do is I would literally come to an hourly, and I think most traders would do this as well. So let's say gold here, for instance, I would be looking at, before the CPI event, I would have and I mean, rightly or wrongly, it probably would have worked out for me in these two cases. But I would have like a buy order here or a sell stop order here, and then, wait to see which one triggered first, and then try and cancel that one out quick enough to for it not to get triggered. But I got burnt a fair few times doing that. And I always remember one real particular one, which was dollar yen, and I was trading an on-farm payrolls event. And all week on Bloomberg, all I heard was, this is going to be the worst jobs in history. They're forecasting the worst jobs ever. So I was really confident. And even that, I put a sell stop order in, I put a buy stop order in. But on the sell side, I put like a bigger order in. It was like a chunky order, because I was like, wow,
okay.
The sell side is more likely, Anyway, it turns out it was the best jobs in like 10 years or something. And I got absolutely spanked, because price action just went bosh like this. And I was offside on this one massively, onside on this one. And, luckily I managed to get out without too much of a loss. But that is the danger of trying to trade news events like that, is if you have necessarily, it's going to be high volatile, but you don't have the understanding of what it means, then you can kind of be caught on both sides of the coin. And that is something that I learned a very harsh lesson at that point as well. And I know you wanted to bring this up as well, but on volatile news events, spreads can widen quite significantly as well.
Yeah, you've actually I love that story, because for two reasons. The first is, in my early days as a junior FX trader, I did the same thing. I was like, I wonder what happens if I put a stop order here and there. And we used to have a program that it would make like a dice rolling sound every time one of your orders was executed. And when I heard the two dice rolls, I was like, oh, yep, I know what's happened. And I had a look at the fills, and yep, okay, so now, luckily it happened the first time, and I just remembered it ever since. And unfortunately, this is how you learn most of your lessons, that something silly happens, and then you just remember, okay, I'm not going to do that again.
I need that roll of the dice noise in my life every time. That sounds incredible to have, to be honest.
Yeah, it's I can still remember that happening. But it goes back very well to the question you asked me a few minutes ago with what happens institutionally. So one reason why that happens and you get this big move at the start, the first thing is, yes, it is a more volatile time. Traders will be trading in both directions. But what you also find is that spreads widen significantly. And so what happens when a spread widens, and it's not because, as so many, I know the sales teams at our brokers get a lot of emails from traders saying, you found my stop loss, and then you widened the spread so that you triggered my stop loss so you can steal my $200. I can assure you that is not what we did. That is because the prices we get from our liquidity providers did that, because their liquidity providers did it to them. If you go on up the line, you're getting to Deutsche, UBS, Barclays, right? The reason that happens is because twofold. Firstly, the spread is a function of risk. So going into a news event, obviously higher risk means a higher spread. So what will very often happen is the spread will widen, and that's why your orders are getting triggered on both sides. But secondly, when I was at Susquehanna, when we were going into a major news announcement or a company was about to release their results, if it was happening during market hours. We're sitting there with quotes on both sides. So if you think about, the way you have a currency quote, you have a bid and an ask. It's the same thing with options. You have a bid and an ask as well. Leading into a major announcement, we would just pull all the quotes out of the market. So we knew for sure we would not get traded against. And luckily, you don't have to go into every single option series, every single stock, and just click a button. There's one giant button that you press and it just pulls everything out in one go. Now, what happens if multiple market makers do that? Suddenly, all liquidity comes out of the market, and that will also cause the spreads to widen as well. So you'll see that even institutions that you think theoretically have much greater insight than you, they also don't want to touch the volatility going into the announcements. They want to trade what happens going out of the announcements, the aftermath. So that practical move of either pulling their quotes entirely or at least reducing the amount of volume they have on the bid and the ask, that is what is also contributing to these spreads widening as well. So I thought that question actually tied in very nicely to what you were describing immediately before.
For sure. And on the institution side, how this is completely off subject in terms of spreads, but
sure.
How much more information do you have versus a retail trader when it comes to a news event? Is it just research that analysts have done, or do you get like does an envelope come across the desk and it's like this is everything you need to look for? Because I'm just interested for personal reasons, because I've never been on the other side.
No, it's a very good question. The answer is not going to be as sexy as people would like it to be. It's they don't really have greater. Okay, I'll phrase it like this: you have access to a lot more resources. So yes, you do have access to more research reports, and the research reports you have access to do come from the bigger banks. There's no reason why a retail trader could not also subscribe to those, but it would be proportionally a higher cost and probably not worthwhile for an individual. But in terms of having a greater insight, no, it's not like the head of the trading desk of any of the major quant trading firms has Kevin Walsh. So Kevin Walsh is the new, actually, is that how you pronounce his surname? I
think so. Yeah. Kevin Walsh.
Walsh. So Kevin, no one has his or Jerome Powell's number on speed dial and is calling them up beforehand and say, hey, just blink twice if it's going to be this. It's nothing like that. You have more access to info, and you also have the systems to be able to react faster. That's the advantage they have over retail traders. But in terms of having actual insight into the data, I find that at least in my experience, they don't really have any greater insight than a retail trader. They just have more experience in how to interpret data and how to react to it.
That's very interesting, because I always assumed that I assumed that they had more data, but I didn't know necessarily like if it was something that was just either I don't know, just access to something magical on the other side. Because obviously, you've got things that aren't necessarily accessible for retail, like Bloomberg terminals and all these different types of institutional terminals out there that I just think are retail traders really at a disadvantage, or is it just because of the lack of education on kind of trading news events and around that kind of stuff? Is that just the downfall of a retail trader when it comes to this type of thing?
I think so. I think more and more as the world has gotten more connected, I'm going to show my age now, but we're in the internet age now. A lot of our clients and our listeners probably don't remember what it was like before then, but this has made it's kind of leveled the playing field, I think, a fair bit in terms of the info that's out there and the consensus you get from a free site like Forex Factory, or the one that you pointed out before. You are going to get most of the way there to what major instos have. Now, what major instos might have that you don't, besides the two obvious things like the scale and the speed? I mentioned before, they have access to, I guess, they know what very large orders are coming through in the market. Because quite often, if another major insto wants to make a trade, it goes to a broker. That broker will then call up all of the market makers that they have a relationship with. And if you're one of the major market makers, you'll be on that call list. And so you will have some sort of insight that, oh, actually, there's a few big orders coming through on, again, I'm going to use an options example, but on this particular stock, their calls, so that's on the upside, and they're around this level. And when you start seeing these come through, you think, okay, someone must know something. I don't know what it is, but they're all facing one particular way. And so you will then, if you can then have that piece of info and say your colleague who works in a slightly different bit of the market sees something similar that is also consistent with that, and you happen to talk to each other in real time, you can then see, okay, so we're getting big orders over here in this, we're getting big orders over here in this. We don't know why they're coming through, but we know that they are coming through, and they're probably more informed than we are. And you can start forming opinions on that. And that actually is quite a valuable tool it's something the retail traders will just never have access to. You'll never get a chance to see those sorts of things. So someone there has info, they're probably the most informed, but because their orders are coming to us, the market makers, we are then the next in line to be informed. And the people who aren't in that room will just have no idea that these are even happening until after the orders go through, by which time it's quite often too late.
Right. Okay.
So there are different hierarchies as well.
Yeah. Yeah. So really, it's almost like why I use commitment of trader reports and look at those kind of things. I think, well, they are going to know more than me. Like if they're like shorting pound contracts at whatever levels, I'm like, well, they must know more than me of what's going on, or at least they're interpreting it a little bit differently, or maybe there's something that I've missed essentially from that. So it kind of works in a similar way then, I guess. Like you're looking
at that's exactly it.
The big orders.
If you know who is smarter than you or who is more informed than you, if you just jump on board with them, even if you don't fully understand why, as long as you're ready to exit once it turns against you, that can be a consistently profitable way of doing it, as long as you are following the right people.
Yeah. Because I know options is becoming a bigger market as well, like globally. And a lot of retail traders now try and look for options, kind of volatility and levels and stuff. And I know, especially when I look at, I think I'm right in saying this, the put to call ratio is something that I look at from time to time. Because when I'm looking at kind of risk in the market, I think if the put to call ratio is above a certain level, it can mean that actually, there could be some downside to stock markets and stuff. So I definitely keep an eye on that. That's interesting I wonder if there is something actually out there these days that does give you a little bit of that information, but someone may be.
It's a good start. I mean, put to call, the way you use put to call is exactly the way I would use it. And I hesitate to say that you can get too much out of the options market, because I think it is quite complicated and you kind of don't really need it that much for Forex. But just one thing that I will point out for a lot of people, when you look at, if anyone uses the VIX, so that's the volatility index, the VIX, I think a lot of people intuitively sort of understand what this is. If the number goes up, that's more volatility. If it goes down, that's less volatility. But that VIX number is actually coming directly from options pricing. A lot of people don't realize this, but that is one arena where the options market plays a very big part in reflecting how markets are going to move, especially equity markets are going to move going forward, or what people are expecting. So it's there in the background, but I wouldn't worry too much if I was a retail trader and didn't fully understand the ins and outs, because there are a lot of things there that are far more complicated than you'll ever need.
No, for sure. No, that's great. That's a great insight, because we obviously don't talk a lot about options markets here because we're a CFD broker, of course. But I always think that being informed is better than not being informed on certain elements. The more information you have, I feel like you can make better trading decisions. So, just having that little insight is pretty cool. So, thank you for that. Appreciate that. So we've gone through quite a lot today. It's already been 45 minutes. I did not realize how fast this has gone. So if there are any more questions, please feel free to drop them in the chat. We've gone through a lot of stuff today. We've talked about sort of, I actually was making a little bit of a presentation in the background whilst we were talking, because you were saying a few things that I thought was pretty cool. So
that was very, very efficient, John.
Yes, thank you. There is this great tool called AI and stuff that has really just helped this process speed along. But yeah, we've been talking a lot about trading major news events today, sort of how to look at the expectations versus the reality, how to potentially quantify that using other sources such as the US bond yields, and how to not necessarily trade the actual event, but making sure that you can trade after it. And one of the flows that Lynzy was explaining earlier is waiting for that sort of breakout on the news. Instead of chasing that initial move, wait for the breakout to happen, look for the pullback, and then look for the resumption of it. And we looked at a little bit of a trade that I took on the PPI data of gold, which worked out really nicely using this similar method. We also talked about the spreads and how the spreads can widen on these large news events as well. We have got a question just dropping in. Perfect. Thank you. In option market, which time frame is likely safer to trade? Is there I don't know much about options markets, so are there time frames? Is it similar to CFD trading?
So I'm going to anticipate what this question is really getting at, and apologies I didn't catch the name, but apologies if this is not actually what you're asking. But John, you mentioned that options are becoming more and more popular with retail traders, especially it's a concept called 0-day options, which means that they expire on the current day.
Yeah.
And what you'll find is that a lot of these it's consistent with the popularity of predictions markets nowadays as well, where people just kind of want a binary outcome. They just want to know, or they want to take a bet on, is it going to close above this price or below this price? And in that sense, it really is no different to sports betting. And in that sense, I'm not saying that this is like not a legitimate form of trading, because it is. Like, a good trader should be a decent sports bettor, should be a decent poker player. You should be good at all these forms of things that are gambling, but not 100% gambling. But I would say that people conflate options trading that institutions do or that market makers do with these sorts of new products like 0-day options or even binary options. So for most retail traders, what they're doing is they're trading options as a levered punt, really, if you think about it. Like, instead of buying the underlying stock, I can just put out a small premium, buy a call option, and participate in massive upside if I'm correct about this. Right. That's not what instos and market makers are doing. They're actually trading the calls and the puts, long and the short, but they're actually trading the implied volatility. And I won't get into any more detail on that because it does get a bit complicated. But basically, there are 6 inputs into an options price, and 5 of them are observable in the market. And the one that is not is the implied volatility. And implied volatility, incidentally, is what goes into the VIX that I mentioned before. So they're actually trading something very different. They're trading volatility. Right. Most retail traders have no idea, and they don't have the models or the data to even do this anyway, even if they do understand it. So I'm a little bit reluctant to answer that, but if you're talking about which sort of options to the time frame, most retail traders are trading that shorter time frame, so they don't have to worry about the future volatility. But they are really just kind of taking leveraged bets, and the safer version is just to go for the underlying asset, which quite often is equities.
Okay, cool. Just one thing that I caught from that was, like, you think traders should be good sports bettors and stuff. I just want to let you know as well. 2 years in a row, I have won my what's called the Guess the Scores, right? Which is so Guess the Scores is a game that my mate does every single year, and it's always the same team. So it's Aston Villa, who I support, a local club called Warsaw FC, and there's one more. What's the other team? Oh, Birmingham City. Yeah, I knew I'd forget that one because they're like Villa's biggest rivals. Because they're like the second biggest club in the Midlands, arguably. So those three teams, basically every week we bet on the scores of those games, and we go, okay, well, this could be either 1-0, 2-1, whatever, all that kind of stuff. And I've won that 2 years in a row, but I've done it because I kind of saw a pattern in what was happening. And I was like, well, if I pretty much predict 2-1 nearly every game when the team was at home, I would only get it right kind of like once every 3 weeks, but the amount of points that I would gain from it would be high enough to kind of like punch me up in the league. And then if I do it and I get, I called it the 2-1 strategy, and like everyone laughed at me. But I told my brother-in-law, he was like, why are you doing so well? And I was like, I'm just betting 2-1 most of the time. I said, like, sometimes I'll look at it and I'll look at, obviously I would look at who they're playing and how many goals they've scored or whatever and stuff like that. But I said, the large amount of the time I bet 2-1. And he started doing it and he nearly caught me up at the end. So I was like, I should not have given away my strategy.
No, I think
you said that.
You've really... No, and you've actually demonstrated exactly why, because you've used a lot of your retail trading skills in that, because firstly, you're taking emotion out of it and you're looking at data. So you kind of, who you want to win, but you're also trying to win this side competition, and you can separate those two things, which is why generally I do quite well in office footy tipping comps as well, because I know which team I want to win, but I also know they're not very good. So I don't tip them every week or even close. But you've used real data, and you've got the discipline to find a system that works and stick with it and adjust it if you need to. And I think you'll find that if you apply that sort of reasoning to the markets, you will do well as well. It is the same way that if you apply that to playing poker versus letting emotion take over, you should do well at that too. And I didn't make that comment as a flippant thing. A lot of great poker players do come from these big hedge funds as well, and it goes the other way. Like some of the most successful poker players that you see on TV, they have been hired. Like I think the most winning female poker player, at least in tournaments, is a lady named Vanessa Selps. She made a cameo appearance in an episode of Billions, but she was also hired by Bridgewater, and I think, if I'm not mistaken, she jumped over to maybe Jane Street after. So the market does believe that there is a significant overlap in these skills. And I don't know if I've mentioned this, but at Susquehanna, the founders were professional poker players. So it was compulsory when we joined the firm to have poker lessons every week from one of the traders in the Stat Arb team, who actually has a World Series bracelet. So there is significant overlap because both of them involve decision-making under uncertainty. And if you can sort of separate the emotion from the data and the decision and be disciplined with it, you can be successful in all these different disciplines, which I find, very fascinating, actually. It's something a lot of people don't expect.
It is. It's really fascinating. Maybe we should set up an Anzo poker tournament, and you'd absolutely wipe the floor with us.
Already win. Already in. But I always say to people, I think I should be so much better at poker than I actually am. I think the old Susquehanna people would be mortified if they saw me actually play. What have we been teaching you this whole time?
Love it. I love it. Well, thank you for joining me today. We've gone 54 minutes, and I think we've covered a lot in today's session. If anybody is interested in joining the Anzo Capital trading team here, you can join us and sign up on our website, and obviously you'll see information from me and Lynzy from time to time. So join us over there. If you want to join the free Telegram channel as well, just follow this QR link too, and you can join me. I put a lot of news updates, chart updates, and all that kind of good stuff in there as well. So yeah, thank you for joining us today, Lynzy. Thank you again. You know, always love having these chats with you, and I always love getting that little institutional insight. So really appreciate it as always, and thank you for the comments and questions today. It's been actually quite refreshing for us to have that, which is nice. So we must be doing something right today. So appreciate you all, and thanks for watching, and we will catch you very soon. Thank you.
Thank you.
On the court or in the markets, performance is everything. That's why Anzo Capital is helping to power your trading game. Now official partner of the Phoenix Suns.